Hello, everyone, and welcome to Tax Efficient Strategies in Retirement Planning. I'm Doug Famous, CFP with Famous Financial. Folks, we work with pharma, biotech, and med device professionals across the nation, and we have a lot of executives, of course, and those that are highly compensated, and certainly tax efficient strategies have been in order. And this is really based on casework and things that we have wanted to kind of put out there in an educational opportunity. And these are really deliberately provocative because what we find in this broader umbrella of advisory services, that is financial advisory services, is that there's a lot of what we would characterize as portfolio managers. And then there's more of what we would encourage is more of a comprehensive planning approach to, again, retirement planning. And the reason we believe that that is so important to kind of consider here is that when we talk about tax efficient strategies or really other strategies in retirement planning, we want to be looking at a broader array of tools and actually a broader array of the dashboard of what you really are looking at in your financial house. So the agenda or the topics to overview here are, folks, some of you are going to have different personal tax goals from one another. So to establish that and to understand that. Number two is assessing really what is your current taxable mix? What is your financial house look like right now? Where are the assets housed versus where would we like them to be housed? Let's say the desired. What are the tools for greater tax efficiency? What are the tools in the shed? And of course, estate planning considerations, which is that end of life legacying of wealth. And what is the consideration about that? And do I need to even be thinking about that yet? Well, let's talk about that. And let's think historically first. Where have tax rates been? And we're talking about the highest marginal income tax rates over the last over 100 years. And you'll see, if you follow that orange line, it's been a lot higher in years past than it is currently. And we might feel the pressure of taxation now, and that's legit. But boy, where do you think they're going? And again, I don't say this with any kind of crystal ball. I don't know. But where could they be going? Is certainly it's possible they could be even higher in the future. So as the questions are at the bottom, what percentage of your assets will be taxed when you access them and what will be tax-free? That's important to understand right now. This is the time to really get to work on that financial house for the long run. And what strategies do you have if perchance it might even be a rising tax environment in the future? So when we think about the current financial house, let's take a look at really where these assets are housed. Taxable income or those like brokerage accounts. It's your stocks and things of that you have in a non-retirement account. Savings and CDs are even throwing off taxes now because you're actually getting paid an interest rate, which that's kind of new but attractive now. And of course, even your stock options and your RSUs that you get, these are really important things to understand. This is that kind of cap gain side of the house, if you will. But folks, where a lot of assets that we find are housed, and think about it, how long you've been contributing to that traditional 401k that you got many years ago. In fact, that was the only option you had in a 401k was traditional. Have they been large? Do you have traditional 401ks that are large? IRAs that have been rolled over from prior employers, et cetera. And then some of you, if not many of you, have the pension. Yes, it's the lump sum and or the income annuity pension. Again, never been taxed money. That's going to come out taxable in your retirement. So that's really important to understand how much is housed in the middle versus the right side. Even though you're getting this tax deferred benefit in your next year's taxes, and we love that. Will we love the long game of that if we only kind of focus on this middle column here? And that's where we encourage you to be really thinking about today How do you bolster and build the right side, the tax-free distribution side with Roth IRAs, Roth 401ks? We'll get into that a bit. 529 plans. This is the Roth-like for educational expenses. Cash value life insurance. Really? Not so sure I know much about that, Doug. And we'll talk about that again for Roth-like distributions and things of that nature to understand. And muni bonds, that's tax-free income. And HSA accounts, again, one of the most tax favored, if not the most tax favored, for those of you that have access to that, the HSA or health savings account. So now let's briefly look at what many of you can't contribute to, and that's a good thing because you make too much, is a Roth IRA. So Roth IRAs, if you had any build over the years when your income was lower, hey, great. If you have a fairly good footprint of that currently, I mean, great. But let's take a look at what other ways we can get more Roth into the house. Because again, it's this, you're paying the taxes now, it'll go in and grow tax-free, and it will be distributed tax-free. That's the key in understanding. So Roth 401k gives you that provision. No matter if you make $1 million or more a year, you can still contribute to your Roth 401k. So there's ways to do that. But just understanding how to use that is something that we want to really encourage you to understand the long game and where Roth can be integrated into your financial house. So Roth 401k, you got a $30,000 limit if you're 50 and above. That's a fairly significant, way to contribute to your right side of the financial house. So let's go into another way to do that. And this is typically later in life, and that's via a Roth conversion. Many of these are done when you start to have your income lower, you're about retired, you're semi-retired, and you can take on the Roth conversion, which means you take an IRA traditional and move it to your Roth IRA, and you would assume the income that year. So it would be a taxable hit. So you want to really work with your tax professional. And let me kind of stop here as a part of this whole planning versus a portfolio concept that I really want to illustrate here. It's very important because it is profoundly what we find in this kind of work. There's a lot of, very well-to-do, affluent, folks out there that are leaning on a portfolio manager and thinking, or maybe kind of assuming they have a plan, and unfortunately, that wouldn't be a plan. It's just a portfolio. So you want to have your CPA professional in the mix. That's who would really kind of help you with that taxation and kind of take the tax leadership of your team, financial planner as such, be a part of the team, the tax attorney or the attorney drafting the wills, or the estate planning attorney, et cetera. These are the professionals that can kind of all circle around for your best interest to ensure that you have that good, more planning chassis. Okay, so Roth conversions are attractive in minimizing the future bolus of these large IRA balances. And that's really important, again, to balance this right side of the house. So now life insurance strategy, again, life insurance, what's the taxable impact of life insurance? Well, for term insurance, if you die young, term is great. You have group term at work. Great, wonderful. You have maybe term policies that you've had over the years. Great, wonderful, good strategy for getting a tax-free death benefit to your spouse or your significant other or whatever, your kids, if you should die younger. Problem with term is once the term's out, it's over. It was just a cost on the balance sheet and you no longer have the death benefit, it's over. Permanent insurance, very different, very strategic though, when done well. With all these things, folks, may I add that any of these strategies can be done poorly or done strategically. Investment strategy, we do all, we're into all that. Can be done well, poorly. Life insurance planning can be done well, poorly. So it's really important to understand and get into these areas and understand how do you really use the tool in a strategic way to be symbiotic with the plan. For example, life insurance planning with permanent insurance for the affluent and high net worth. By the way, it should not be integrated for those that are not affluent. That is really bad planning. Term is the place to go for people that do not have much wealth. It's very important to have term on board, especially important. For the affluent and high net worth, understand what permanent insurance does, understand how to integrate it, and what are the benefits. So when you look at the buffer asset, which is the second row, understanding having a buffer asset, you have investments. Think of last year, folks. Big downdraft in the market, right? What happened? Well, you're still working. You've endured it. We've had a big run year to date. We're happy to see it come well back on its way. But what if you're retired last year? How would that have felt if you have a predominantly high stock or even stock and bond portfolio? What would that have felt like? If you were distributing from your portfolio, you would be distributing from a dropping bucket. Stocks and bonds went down last year, double digit. That would have been a very painful distribution. And by the way, may I say, a lack of planning. Okay, that is a planning error. Whenever you're in your retirement and selling all of these depreciated assets, it is a poor plan. That is the result of a poor plan. Or day trading your accounts, going in and out of cash. Again, these are planning mistakes. Now, the buffer asset of a permanent insurance policy, which grows like what? Like a Roth, never taxed again, performs better than cash, never taxed again, better than cash. Then you have this large stable value asset that corresponds to your stocks, which we are a big stock advocate, by the way, because where's your growth come from? Stocks. Very important to have stocks on the balance sheet for the long run, for the inflationary risk protection. But having the permanent insurance, which is tax-friendly, like a Roth, on the balance sheet, when the stocks are down in your future, you take what is called distribution from a buffer asset, allows your stocks to heal and return like they did this year, and you're now good to go because you're now selling stable value when the market's down, and you can sell off stocks when the market is healthy. Very important planning concept. Just that, if you can kind of capture and understand the long game in these things, it's extremely important for your accumulation of wealth. And that's why differentiated assets that are tax friendly are very strategic. Not to mention what we're going to be getting into is the wealth transfer advantages of Roth and permanent insurance. The wealth transfer is important as we think about the 2018 Tax Cuts and Jobs Acts. We've got the sunset provision. And that just really means is that the tax exemption, the estate tax exemption right now is very large. So the exemption is like, wow, it's like almost 26 million, Doug. We're good to go. We're affluent, but we just don't believe we're going to have that kind of wealth at the end of our lives. Okay, you're good right now. What's that going to be in literally about a year and a half? Because at the ticker of 2025 into 2026, it's going to go way down. Now you're at 11. And just think about this, folks. You may feel like, oh, we're good to go, but you may have a lot of years left. We're talking about what, 30, maybe even 40 years from you, or for many of you left. And there's a lot of accumulation there. So think about the strategy. And is this subject to change again? This is a political, ping pong ball. So this will go up and down, and think about how low it's been in years, recent years even. This has been much lower exemption levels. So very important to understand. And again, this is the planning team, folks, to circle the team. It is not sufficient, may I say this for your best interest, to have a portfolio manager as a surrogate to a plan. You are selling yourself short, and you may pay a much greater fee than you think by not understanding these tax advantages and other types of strategic areas of opportunity with retirement planning. Very important. So with all that, let me kind of pull this together in summary. We are looking at, instead of trying to predict future tax rates, which we cannot do, as soon as we try, we will find we are on the other side of it, but tax diversify to enhance flexibility. and reduce the vulnerability for higher future tax rates. That's what we're looking at. Just like we're diversifying a stock portfolio for lower deviation or standard deviation, et cetera, that's what we're doing with taxation as well, folks, is now's the time. So if I can kind of skip to the third bullet there, early intervention is critical right now for successful outcomes. How often do you speak that in your own world, right? You're encouraging people to take advantage of, get their health, get after it early, to assess their health early for better outcomes. And that's exactly what happens in the financial arena. We're not surprised to hear that. And again, I'm illustrating a couple of major areas that I've found in casework over the years to be underutilized and misunderstood maybe to some degree, is how to integrate Roth and life insurance strategies into your financial house for the future. These things are compelling, folks. And to help you to do that, we offer a complimentary consult. These are very well received. We love the educational opportunities that we share. We're very open-handed in doing these, and they have, again, been something we get a lot of positive feedback. So contact my counterpart, Bill Giese, at his email or phone, and we'll be happy to schedule one for you, and certainly hope that you found this provocative and something to stir you up. We have great passion for these concepts because they really do make a difference. And at the end of the day, it's really math, folks. This is money that we're talking about, and usually that has our attention. So, hey, all the best to you. We hope to speak to you soon in the future, and have a great day.